Let's take advantage of your home equity. Today's a homeowner's guide. Homeownership offers many advantages over renting, including a stable living environment, predictable monthly payments, and the freedom to make modifications. Neighborhoods with high rates of home ownership have less crime and more civic engagement. Additionally, studies show that homeowners are happier and healthier than renters, and their children do better in school as well. One of the biggest perks of home ownership is the opportunity to build wealth over time. Researchers at the Urban Institute found that home ownership is financially beneficial for most families. And a recent study also showed that the median net worth of homeowners can be up to 80 times greater than that of renters in some areas. So how does purchasing a home build you wealth? And what steps should you take to maximize the potential of your investment? Today we're going to find out how to harness the power of home equity for a financial secure future. This is Kimberly DiPrima, a realtor with Option Realty Group, working in Chicago's far western burbs, known as the Fox Valley. So what is home equity? It's the difference between what your home is worth and the amount you owe on your mortgage. For example, if your home would currently sell for $350,000 and the remaining of your balance is $200,000, then you have a $150,000 home equity. The equity of your home is considered a non-liquid asset. It's your money, but rather than sitting in a bank, it's providing you a place to live. And when you factor in the potential of appreciation, an investment in real estate will likely offer a better return than any savings account available today. So how does home equity build wealth? A mortgage payment is a type of forced savings for home buyers. When you make a mortgage payment each month, a portion of the money goes towards interest on your loan, and the remaining part goes to paying off your principal or loan balance. That means the amount that you owe the bank is reduced every month. As your loan balance goes down, your home equity goes up. Unlike other assets that borrow money to purchase, the value of your home generally increases or appreciates over time. For example, when you pay off your car loan after 5 years, then you own it outright. But if you try to sell it, the car will be worth much less than when you bought it. However, when you purchase a home, the value typically rises over time. And when you sell it, not only will you grow your equity through your monthly mortgage payments, but most cases, your home's market value will be higher than when you originally paid for it. Even if you only put 10% down when you purchased it and pay off a small portion of your mortgage, you get to keep 100% of the property's appreciated value. That's the wealth building power of real estate. So what can you do to grow your home equity faster? Now that you understand the benefits of building equity, you may wonder, what can you do to speed up your rate of growth? There are two ways, basically, that you can increase the equity in your home. One would be to pay down your mortgage sooner. We shared earlier that your home's equity goes up as your mortgage balance goes down. So paying down your balance is one way to increase your home equity. Some homeowners do this by adding a little extra each month. Some do it by adding an additional mortgage payment each year, or by making a lump sum payment when extra money comes their way, like a bonus or a gift. And it's important to ensure that if you're making any additional payments, the monies will be applied to your principal. Another option to pay off your mortgage faster is to decrease your amortization period. For example, if you can afford a larger monthly payment, you might consider refinancing from a 30-year or 25-year mortgage to a 15-year mortgage. Not only will you grow your home equity faster, but you could also save a bundle in interest over the life of the loan. And we all want those loans paid off before retirement now, don't we? Boosting the market value of the property is another way to grow your home equity. While many factors contribute to your property's appreciation, they're out of your control. For example, demographic changes or the strength of the economy. There are things that you can do to increase your worth. For example, many homeowners enjoy do-it-yourself projects that they can add value at a relatively low cost. Others choose to invest in a larger strategic updates. Keep in mind, you won't necessarily get back dollar for dollar that you invest in your home, but according to the Remodeling Magazine's latest cost versus value report, the remodeling project with the highest rate of investment is a garage door replacement. Cost about $3,600 and is expected to recoup 97% at resale. In contrast to an upscale kitchen remodel, total demolition, which would cost around $130,000, averaged less than 60% of return on that investment. Of course, keeping up with routine maintenance is the most important thing you can do to protect your property's value. Neglecting to maintain your home's structure and system could have a negative impact on its value, thereby reducing your home equity. So make sure you stay on top of recommended maintenance and repairs. To help you with that, down below in the description, I have a schedule of yearly repairs for you as a gift. So how do I access my home equity if I need it, you may be asking? When you put your money into a checking or savings account, it's easy to make a withdrawal. However, tapping into your home equity is a little more complicated. The primary way that homeowners access that equity is by selling their home. Many sellers will use that equity as a down payment on their new home. And some homeowners may choose to downsize and use the equity to supplement their income or retirement savings. But what if you want to access that equity while you're still living in it? Maybe you want to finance a home renovation, consolidate debt, pay for college. To do that, you need to take a loan using your home equity as collateral. There are several ways to borrow against home equity, depending on your needs and qualifications. You can take a second mortgage, also known as a home equity loan. It's structured similar to a primary mortgage. You borrow a lump sum of money, which you are responsible for paying back with interest over a set period of time. Most second mortgages have a fixed interest rate and provide you, the borrower, with a predictable monthly payment. Keep in mind, if you take out the home equity loan, you'll be making monthly payments on both your primary and secondary mortgage. So you have to make sure you budget accordingly. With a refinance, you refinance the primary mortgage at a higher loan amount than you currently owe. You pay off the original loan and you keep the difference as cash. This option may be preferable to a second mortgage if you have a high interest rate on that first mortgage, or if you prefer just to make one monthly payment. Another way is a home equity line of credit, referred to as a HELOC. A home equity line of credit is a revolving line of credit, similar to a credit card. It allows you to draw money out as you need it, a little at a time, instead of taking out a big lump sum all at once. A HELOC may even come with a checkbook or a debit card to make it an easy way to access funds. You will need to make payments on that amount that you withdraw. Similar to a credit card, the interest rate on a HELOC is variable, so your monthly payment can change depending upon how much you borrow and how the interest rate fluctuates. But it's a good way to finance home renovations. Another option is a reverse mortgage. You hear those commercials on TV, but what is a reverse mortgage? Well, it enables seniors to borrow against the equity of their home to supplement their retirement funds. In most cases, the loan plus interest doesn't need to be repaid until the borrower or the homeowner sells, moves, or is deceased. Tapping into your home equity may be a good option for some homeowners, but it's important to do the research first. In some cases, another type of loan or financing method may offer a lower interest rate or a better term to fit your needs. It's important to remember that defaulting on a home equity loan could result in foreclosure. Drop us a line and ask for a referral for a lender or financial advisor to find out if a home equity loan is right for you. We're here to help you in any way possible. Whether you're in the equity growing process, we can help. We work with buyers to find the perfect home to begin that wealth building process. We also offer assistance to homeowners who want to know their home's current market value so they can see if they want to refinance or secure a home equity loan. We can give you a competitive market analysis. Down below in the description is a link to get one automatically. And when you're ready to sell, we can help you get top dollar to maximize that equity. Go ahead and watch this video here next. Thanks for tuning in today. Give it a thumbs up, subscribe, hit the little bell so you'll be notified in each and every video that we send out each week. Thanks for watching. Have a great day and God bless.